Welcome to Money Matters TV. This evening we have a particularly good show for you. I'm Patricia Dunn from the Dunn Group at Merrill Lynch in West Conshohocken, Pennsylvania. And joining me tonight is Charlie Shields from Wells Fargo.
Hi, Pat.
Welcome.
How are you? Good
Fine.
to see you.
And our special guest tonight is Paul Murray, who is a chartered financial advisor and a certified divorce financial advisor with us from PTM Wealth Management. So we look forward to catching up with Paul in a few minutes. But let's start tonight with discussing the market of 2016 and what we might expect in 2017.
Okay.
Interestingly enough, 2016, the markets in the early part of the year were dominated by fears of rate hikes and deflation and recession. And then we saw the 10-year Treasury bottom out in July 8th at 1.37 and then start to climb. And that was a significant date because that marked the end of a 35-year bull market in bonds.
Sure.
And then towards the end of the year, we finally started getting some good earnings, and stocks started to respond and climb. And then, of course, after the election, that's when it really picked up some steam. So it was an interesting year, 2016.
It really was.
Now, 2017 might be a year of transition when we get back to the fundamentals. And that could mean some interesting things for investors. Charlie, what do you see for the dollar going forward?
Well, the dollar, as we talked about a couple of shows ago, the dollar can be strong for a while and the market can rally. It gets to a certain point, if the dollar keeps rallying, that it could hurt the stock market, especially our big companies who rely on being able to export their products overseas. So I have a feeling we're going to get a surprise that the dollar will not rally as much as everyone is afraid it will. We've now had 2 rate hikes, but they've been for such a low base that I don't believe a 3rd or 4th rate hike of a quarter point will have that much impact from here. I think a lot of it's already built in. If I'm right about that and the dollar stabilizes in here, I think we can have a lot left on the stock market rally. What do you think?
Actually, I'm thinking that the dollar is going to strengthen until it's at a parity with the euro. But I don't see it as running way ahead of the euro. So I'm very much in agreement with you. Now, you mentioned rate hikes.
Yeah.
2 more are expected.
Yeah.
Given that, do you see stocks again this year outperforming bonds?
Well, when you think back in history, Edson Gould, who was a long time ago but a smart guy, said 3 steps and a stumble. When you've had the 3rd rate hike, the stock market starts to tumble. That rule may not work this time because of what we just talked about. We're starting from such a low base. So I would start to get concerned if they're going from 1.5% to 2% in a 50 basis point rate hike. So I think we have a while to wait before that would happen. Now, if that's going to happen, it's going to mean the economy is recovering, long-term interest rates are going up because of a strengthening economy, which is good. So I am still leery of putting a lot of money into long-term bonds right now because I think we may have the long bonds go up in yield and down in value for a while longer. I think you're okay if you try to get that sweet spot, especially in the municipal bond area, intermediate term, because it's already kind of lopsided that you can get more in tax-free yields in a good quality municipal bond than you can get in a 10-year government bond, and the government bond is taxable and the muni is tax-free. So bonds, I would stay intermediate or shorter. I still think the stock market's got a ways to go before we have to worry.
I agree with you, and I do believe that we're going to outperform, stocks are going to outperform bonds yet again. It'll make it 6 years in a row now that stocks have outperformed bonds, and I think that's a pretty safe bet for 2017. Now, when it gets to stocks, are there any particular cap size that you're looking at and thinking will do well?
Yes, we have shifted some allocation over to small cap stocks because they don't have to worry about the dollar continuing to rally and what that will do to our big, huge multinational companies. And late in 2016, I don't want our viewers to market time what we're saying here because this is taped at different times in different places, but late in 2016 the small caps really started to take off as the dollar started to rally, and I suspect that they will continue to do that. And I also think you might want to lean toward the value side on the large cap stocks.
I agree. And I also like the cyclicals in this environment. Now, how about sectors that you think will do particularly well and maybe sectors you think won't do so well this year?
Well, I wouldn't be surprised if healthcare comes back.
Me too.
The election, so those type of stocks have been beaten up, and then when Trump got elected, the biotechs rallied and then they fell back, and I think they may have some more left, and I think the big pharmas may do pretty well. I'd be a little bit leery on the utility side. I'm afraid that people will go for the cyclical stocks, and they have to find the money somewhere because lately we've been looking at rotation and not completely selling out of the market. So I'd be careful about the utilities and the consumer staples.
Well, I would like to add a couple more. I do like the financial stocks because financial stocks thrive when interest rates go up. And information technology is another one I put on the plus side. I wholeheartedly agree with you on the negative side. We do want to stay away from utilities. But I'm also thinking energy is not likely to do well in this environment, nor materials. So that's kind of my list, and time will tell as to whether or not we're right.
Yeah, one of our steel stocks went from 7 to 35 in the last year, and I don't see how I can make a lot more on that one. So now that it's a new year, we're selling that one into strength.
Okay. Well, now the $64,000 question. Given that 2017 will be a year of transition and a return to fundamentals, do you think active management or individual stock picking is going to be the winner at the end of the day?
Yes, I think active management is going to be beating the indexes. Everybody has decided all you have to do is set it and forget it, buy the indexes, and everything will be fine. And I have a feeling the quality of the stock within an index is going to matter. And so if people get disappointed with their indexes because they're not doing as well as portfolio managers are, they may start selling those indexes, and you can get this thing back where it belongs in balance instead of way out of whack in favor of indexes. What's your thought?
I absolutely agree. I think that active management is really going to shine this year because as people return to equities, I think there's going to be a lot of cash flow into separately managed accounts. And that gives the portfolio manager more to work with, and as a result, I think the performance will be better. So I agree with you. Well, do you have a few minutes for a viewer question?
Sure.
All right. We have Janice Kelly of Philadelphia who asks, how do you see valuation in equities and in bonds? Couldn't relate more to what we've been just talking about.
That's correct, and you have to be careful not to just give a broad answer to either of those questions, and we've been discussing some of that. Valuations in the stock market, depend on the sector you're talking about. For example, automobile stocks can get to very low valuations when they're out of favor, and then they can move up from a 7 or 8 PE in tough times up to 14 or 15. On the other hand, if you have a fantastic technology stock where the earnings are going up faster than the stock price is going up, you can see multiples of 30 or 40 times. So valuations depend on the sector you're talking about, the economic environment you're in, and so I don't want to try to give somebody a 2-paragraph answer on how to look at a price-to-earnings ratio and decide to invest. The bond market, I've talked about the 3 vigilantes. Gold. If gold is going crazy, it's telling me inflation's coming back. If interest rates are climbing rapidly, it's telling me inflation's coming back. And if interest rates are rising for those kind of reasons, it can be very ugly like it was in 1979. If interest rates are raising kind of grudgingly because the economy's recovering, that's okay and that's healthy. And that probably means that bond yields don't have that much further to go. So I'm afraid I can't give our viewers and listeners a pat answer of what to look for, but at least I can suggest some things they should be looking for.
Well, it sounds like a good advice would be to seek their own personal advisor.
I agree.
All right. If you have questions that you'd like us to answer here on Money Matters TV, here's how you would submit them.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our hosts and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Well, welcome back. Now our program is going to turn to our special guest, Paul Murray, who, as I mentioned, is an accredited investment fiduciary, a chartered financial consultant, and a certified divorce financial analyst. He comes to us and his firm, which is PTM Wealth Management, is out of Chalfont, Pennsylvania.
That's right.
And Paul's going to talk to us about insurance. Welcome, Paul.
Thank you.
Hi, Paul.
Good to be here with you. Appreciate it.
I'm going to start. How does insurance relate to wealth management, in your opinion?
Well, it's a great question because really insurance is all about protection and providing benefits for people, whatever the case may be. And wealth management has to focus on that. But really the hardest thing about integrating insurance with wealth management is getting people to talk about it. People don't like to talk about insurance because it's all about bad things that can happen. Getting into a car accident, having your house burnt down, passing away, needing long-term care. So often in wealth management, what we need to do is to get people to talk about, you know, the things that might not go the way that they thought that they would. Because everything is about planning and the lofty goals that we have, but there's the what-if scenarios. And so integrating insurance, particularly life and long-term care, disability to some extent, into a wealth management plan, a financial plan, is really integral.
Paul, do you focus on certain products as the best, or of the list of products? Are there some you favor and some you don't favor so much?
Well, I try to take a holistic approach to addressing the issue of whether someone actually needs insurance or not, because my main concern is if I'm working with a client, I want to bring highly rated, reputable insurers to the table. Beyond that, I don't sell auto insurance or home insurance, which I mentioned, but again, long-term care, things like life insurance, disability insurance, these are things that can really derail or at least address the financial plans of clients going forward. And I think that that's probably the most important of the lot, really, for me.
Well, now I'm sure in your practice you have people come to you of all age groups, young couples just getting started, starting a family, mid-career professionals, those approaching retirement. And how do you answer the question when they ask you, how much insurance should I have?
That's terrific, that question, because I think we find, all of us who've been working in financial advice for a long time, is that there's an insurance person who sold me a $500,000 policy and it's $50 a month and it's a 10-year term. Well, how did they ever arrive at that number? What does that number mean? What is that $500,000 in coverage really going to address? What we want to do is to sit down and take a financial appraisal of everything in the client's life. What are the issues? How many kids might need to go to college? What's the mortgage balance? What type of an income do you have? What if something happens to you? Whether you get injured and you can't go to work, or what if you pass away? What kind of income replacement do we need for the family? So every case is different, and you mentioned a couple of different demographics, the young, the people in their 40s and 50s, those near or at retirement age. We're all going to have different needs, and it's the job of a financial advisor or wealth manager to really look into, what those specific needs might be and what the solutions are.
As long as I've been an adult, I've heard this discussion about term insurance versus universal life or what have you, and a lot of people have a theory, I'm going to invest just in term insurance, which is a lot less expensive, and I'm going to invest the rest. And I suspect that 9 out of 10 people I've heard say that didn't invest the rest. But
Right.
What's your thought?
Well, that's never happened in any of the cases of my clients either. I think that that's an interesting concept, but in practice it doesn't work. And the reality is that term insurance does fill a need. For example, I work with a lot of people in divorce, some of whom are receiving alimony and child support for a period of time. Well, it makes a great deal of sense to have a term policy to cover those payments if the paying spouse should die, right? Another example would be to retire a mortgage over a period of time. Maybe a term policy would address that need. But the real issue is, what happens if you get to be 50 or 60 years old and you have a health event? And now your term insurance is in its last year, and you're not necessarily going to pass away, but you're not eligible to receive insurance going forward. And I think that that's a really critical issue. One of the other things I like to focus on a little bit is some of the saving strategies that really can occur within permanent insurance. And there's 4 types of permanent. You mentioned universal life, there's whole life, there's also now indexed universal life, and there's variable universal life. So part of the evaluation and the conversation with the client is around what's the best solution for what they're trying to accomplish.
Well, to that notion, there's been lots of discussion around the idea that is insurance useful for funding a retirement, or now I'm retired, I don't feel that I need insurance anymore. So the whole notion of insurance and retirement, how do you address that?
Well, you know, for those who have selected term as their option, eventually it's going to run out. But
True.
for those who chose the permanent option, they may be surprised to know that under the IRS code, they can actually pull any cash value that's accumulated in that permanent policy, universal life, whole life, indexed, variable. They can have access to that free from income taxation. So, whereas with their 401k they may have amassed $1 million, let's say, $500 or $1 million, and they pull out of that by RMDs or because they want income, it's going to be income taxable. The money that they take in cash value out of these insurance products by withdrawal or borrowing is free from income taxation. So in a way, you can supplement your retirement income with truly triple tax-free income by using a permanent policy. So a lot of times what we're going to do at retirement age is to evaluate what the product is, what's the cash balance. A word of caution, and that is a lot of these universal life policies that were sold in the late 80s or 90s made certain assumptions about interest rates that are causing them to lapse. Exactly. So now we're at age 65, and we're faced with the reality that we're in an extremely low interest rate environment, a lot of which you addressed in the first part of the segment here, and these policies will lapse unless we throw a lot more premium dollars at them. So we're doing reviews and evaluating the benefits of keeping the policy or just kind of running it out, whatever the case may be.
I'm fascinated by the subject of long-term care. I've kind of watched as the years go by, and I've seen some firms drop out of the long-term care business. They used to make assumptions that were way under what it was going to cost people to be in a nursing home. So who is it appropriate for now to get long-term care insurance? And talk about some of these pitfalls that can trap people to think they're okay and then they're not.
Charlie, thank you for bringing up the point about the insurers. Virtually all of the insurers have dropped out of the traditional long-term care, where I pay a monthly premium for the rest of my life, and it's going to pay me $3,000 a month for as long as I need it. Well, they made a lot of mistakes on their assumptions, and for that reason they're out of the business. Today we actually have a couple of different types of plans. We have the whole life plan, where you can access the death benefit in life for long-term care. Believe it or not, it's true. If I have a $500,000 whole life policy with a rider for long-term care or chronic illness, I can access that $500,000 in life and use it. There are other plans that focus on lump sums that you put $100,000 into a product and provides $400,000 in long-term care benefits. There's a lot more innovation in the industry, and I think it all goes back to finding out what is the right solution for the client. And some people don't need it. If they can self-finance their own long-term care, should it happen, I'm all in favor of it.
And unfortunately, at the other end, there's people that just can't afford it, and
True.
They just have to hope for the best, right?
And unfortunately, that's true. And the earlier you start to get a game plan together, if you're in your 30s or 40s, to provide some solution for that potential outcome, whatever it may be, I think it's to everyone's advantage.
Do you have any thoughts on what net worth it would take to be able to self-finance?
Wow, a great question. I mean, just healthcare costs alone in retirement can be $250,000 for someone over the age 65, you know, with premiums for various things, Medicare and copays and all those kinds of things. But when you tack long-term care on top of that and $100,000 a year or more in nursing care costs, to do the math at this table would be difficult, but you know, let it suffice to say it would be an enormous amount of money.
Yeah, so
right.
$10 million at 4% would be just about covering the nut after taxes. So
There you go.
There's only a few people that are in that situation.
That's true.
Let's talk about disability insurance. There's people that work for an individual firm that wonder, should I be taking this that my firm is offering me, and then other people don't have access to that. So in both situations, should people have disability insurance?
I think it's a great idea. You know, one of the other areas of life insurance is the group plan. The group plans are great. They're cheap as long as you work for the employer. When you leave, you no longer have the coverage. The same thing is true for DI plans, disability plans, where the your employer will offer you a very inexpensive plan, but if you leave the employer, you may or may not get another plan at another employer. So an individual plan is advantageous for two reasons. One, it's portable, and the other reason is if you're paying your individual disability insurance policy premiums out of your own pocket, those benefits that come to you are free from taxation. Whereas if you receive the benefit from an employer, it could be taxable income, which obviously reduces the benefit. So that's an important calculus really for the investor or insured.
That's a very good point. So if the individual pays for it themselves, and they have to use it, it's one of those things that you get fire insurance on your home and you hope your home never burns down. Same thing with disability. But if it did come to pass, then the disability income would be tax-free.
That's correct. That's correct. Very important distinction that it's got to come out of your own pocket. You need to be making it. You can't be receiving it as a benefit. And often overlooked, and that's where working with an expert, in focusing on these issues is really important. It all goes back to people don't want to have the conversation about these bad things that can occur in their lives. But if they ignore them and they find out that they run into one of these problems, it could be a real disaster for them and for their family.
And just generally, what's the difference between short-term disability and long-term disability?
Well, the long-term is going to cover someone up to age 65, but it's typically going to have an elimination period of about 90 days or so. Short-term being something that addresses that interim period typically. Most disabilities don't last very long. They'll put somebody out of work for 2, 3, 4 months or something along those lines. So a lot of times the long-term disability is not ever going to kick in. The same is actually true of long-term care. There's a lot of people who need it for a relatively short period of time. They go off of it, and they may need it later in life, but it's not true that everyone who uses long-term care, as an example, will be in it for 3 or 4 years and then pass away.
Suppose one of your clients says to you that I've always heard that I should just protect my income with life insurance. I've heard that a lot from people. And from answers you've given earlier, it sounds like there's a lot of other issues too. But generally, do you hear that a lot? And what do you say to someone that asks you that question?
Well, that's a great start. I mean, if somebody's already thinking about that, it's a great start. But then let's not ignore the kids who might need to go to college. Let's not ignore the debts that you may have that you may not want to encumber your surviving spouse with, whether it be a mortgage or otherwise. I'd say that the saving strategy might not always be front and center. That has to do with their ability to pay maybe higher premiums, but we want to address that issue first for sure.
Let's switch to the divorce side of things for a moment.
Sure.
I'm wondering, the divorced spouse, assuming that it is the wife and that she has the children, insurance needs there. The thing that immediately comes to mind is if something happens to her, there has to be a death benefit on her for the benefit of the children. Are there other insurance aspects that she should be looking at as a divorced woman?
Well, I mostly work with the divorced women who need to start a new independent financial future. So I deal with these kinds of questions all the time. I think healthcare is probably the #1 concern, because a lot of times those COBRA plans are going to provide for super high premiums that are unaffordable. So we've got to try and solve that issue. Once we get past health care, then we need to talk about maybe long-term care, because I agree with you that it's great to leave some sort of a legacy to the kids, but a lot of times we have to look at the limited cash flow that might be available and prioritize. And I would look to maybe long-term care and some other sort of what-if scenario down the road, because now you're just one income in retirement as opposed to two, and the whole game plan has really changed. So I believe that having some sort of a life insurance plan can be beneficial for the kids, but at the end of the day, there are some other more important issues, in my personal opinion, like health care and long-term care.
I find when I'm working with my clients, they plan for their own retirement, and the kids are going to get what's left over. And I would assume it's the same in the life insurance
I've been
business.
hearing a lot of that these days, truly. A lot of that, yes.
All right. Well, let's go back to the long-term care coverage, because I do understand that some long-term care coverages actually have a death benefit attached.
That is true. Actually, a couple of the ones that I briefly described, where you have a lump sum that you can invest in, it will provide an immediate death benefit, but it will also provide maybe 3 or 4 times that amount in a long-term care benefit. The new long-term care solutions that I personally sort of gravitate towards is the hybrid life long-term care concept, where you have a life insurance death benefit that you can access in life. So if I need long-term care and I have a $500,000 death benefit and I spend $250 of that on my long-term care, I'm still leaving $250 to my spouse or to my children. And you know, sometimes it comes down to what kind of a premium can you afford.
Right.
But at the end of the day, I think that offers a tremendous amount of value, because with a traditional long-term care plan, if you die, you get no benefit, traditionally. So these other types of plans do have, you know, either a limited or a rather significant death benefit that you can kind of add to the plan.
And actually, that's probably been my biggest objection that I've received from clients, that they don't want to do long-term care because what if I don't use it? I've wasted all that money.
Exactly.
So having the death benefit is gives peace of mind.
Sure. I mean, there's plenty of things. We hope that our house doesn't burn down, but we're going to make, $1,200 a year premiums for the rest of our lives. And I think people don't like that. If they can get something of value for what they're doing, that there's some contingency plan, if they live or die or what have you, having access, I think people like the flexibility.
Mm-hmm.
We've only got about 30 seconds left, but I understand the average stay in a nursing home is about 3 years. Have you heard that statistic? Does
Yes.
that sound about right to you?
It is true, but it gets longer all the time. Mm-hmm. So there's that is skewed by people who die within 2 weeks, people who stay for 7 or 8 years. So it's a tough number to hang our hat on.
Right.
Well, this has been a fascinating conversation, and I hope you'll come back again.
I would love to. Thank you.
But we here at Money Matters TV have another great program lined up for you. Our next guest speaker happens to be Nancy O'Toole, which, parlaying on what Paul had to say, helps adult children of older parents find the resources that they need to be able to care for their elderly parents. So it's a very nice follow-up from this. So thank you all for being here, and as always, your money matters.